Hello everyone, I welcome you in the virtual classroom of Economics for Business Decisions. We are discussing unit number 2, pricing policies. Up till now we have discussed the objectives and the factors affecting pricing policy, and now onwards we will discuss methods and strategies of pricing. Let us start. The first method is cost plus pricing, and the another name of this method is full cost pricing. This is the most common method used for pricing. Under this method, the price is set to cover cost, that is to say the cost of materials, cost of labor and cost of overheads, and a predetermined percentage for profit. The percentage differs strikingly among industries. See, what is cost plus pricing? Simply means we are summing up the cost related to product plus we are adding the profit margin. Whatever the figure we get, that becomes the price of the product. Take an example that material price is rupees 10, labor price is rupees 8 and overhead is rupees 2. So the total cost related to production is 20 rupees. Now suppose firm wants the profit margin of 5 rupees, then the price will become 25 rupees. This is the simplest procedure followed under cost plus pricing. And in reality, in corporate world, most of the time, in most of the situation, cost plus pricing is followed. Why? Because this is simple and it makes sure that your organization earns profit. Why? Because we are adding profit, so we are having surety that our price will help to cover cost and it will contribute towards profit as well. Now if we talk about the percentage of profit, then percentage differs strikingly among industries, among member firms and even among products of sample. Means the profit margin differs from one industry to other industry, from one firm to another firm and from one product to another product. Take an example of industries. If you take the example of cement industries, then it is a usual product where the profit margin is not that much high. If you take the example of medicine industry, then the highest profit margin is there in medicine industry. Then if we take the example of different firms, then in the same industry, even the different firms want to earn different profit margin. Take the example of Parle-G. And you can take the example of Bonbon. Parle-G wants to earn the minimum possible profit, and whereas Bonbon earns they tries to earn the more profit. So even within the same industry, firm charges different profit margin, and then it again differs from one product to another product. If your product is luxurious, definitely it would have the high profit margin, and if your product is needy product, then there will be a low profit margin will be there. This may reflect differences in competitive intensity in the industry. If higher competition is there, more competition is there, then lower profit margin will be there, and if low competition will be there, less competition will be there, then high profit margin will be there. Then difference in cost base and difference in the rate of turnover. Rate of turnover you can here understand as a frequency of purchase. If purchase frequency is very high, say for example you purchase 20-30 times in a year, then profit margin will be less. But if you purchase once in a year, once in a 5 year, then definitely profit margin will be high. Take the example of soap. Soap we are generally purchasing 20-30 times a year, and that is why it has a low profit margin. Then take the example of any durable product like refrigerator is there, washing machine is there. Generally we use it for 3 months, 3 years or 5 years. Take the example of gold. We are also purchasing less once in a year or once in a or twice in a year and the like, and that is why this durable products and gold is having high profit margin and the soap is having less profit margin. And again it differs on the basis of risk, competitive intensity, turnover, and risk. These are the few other factors for deciding profit margin. Higher the risk, higher will be the profit margin. Lower the risk, lower will be the profit margin. You know very well the relation between risk and return. Higher the risk, higher the return. Lower the risk, lower the return. Take the example of FD. In bank FD, there is a surety, safety of return, and that is why return is less. Now take the example of share market. There is less safety. There may be a chances of losing everything and there may be a chances of gaining everything. And that is why in share market there is a high risk, high return possibility is there, and in bank FD low risk is there, and that is why low return is there. What determines the normal profit? Ordinary margins charged are highly sensitive to the market situation. They may, however, tend to be inflexible in following cases. Now we will discuss the cases where the profit margin becomes rigid in industry. What are that situations? First, they may become merely a matter of common practice. Sometimes it is just a matter of common practice. Daily we are deciding price, and for daily we cannot change the profit margin. If the cost will change, then we will simply add up profit, and whatever the price we get, we will charge that price in a market. Markups may be determined by trade associations, either by means of advisory price list or by actual list of markups distributed to members. Some industries or most of the industries are having trade associations which decides the price of their product. You may come across this Xerox shops where one printout is stick on the wall where the price of Xerox is written as decided by the Xerox associations. Likewise, if you travel by rickshaw, then they are also having a meter card which is decided by the rickshaw associations for we term it as a meter reading. How many kilometers you have traveled, and for that how much price can be charged, that is given in a list. Now in that case the firm cannot deviate from the price. Whatever the price is fixed by the trade association, they simply have to follow it, and it becomes rigid as a result. Then the third situation is profit sanctioned under price control, as the maximum profit margin remains the same even after the price control is discontinued. Their margins are considered ethical as well as responsible. Usually, profit margins under price control are so set as to make it possible for even the least efficient firms to survive. Thus, the margin of profit tend to be higher than what it would be possible under competitive conditions. Now we are taking the situation where price control exists. Price control means the price is decided by government. In that situation, they will allow to have the high profit margin so as even the less efficient firm. Less efficient means the firm which cannot efficiently work in a market whose cost of production is high. They are not master of their product, and even those kind of firm can earn profit. So even if the government discontinues the price control, the industry continues to have that profit margin. Why? Because it would be higher. If they will compete with each other, they have to lower the profit margin, and it would be not beneficial for them only. So these are the three situations where the margin of profit becomes rigid. As per our syllabus, we need to discuss different methods of pricing and advantage and disadvantages of pricing. So we will directly switch to the advantage of the cost plus pricing. Here one topic we have skipped, that is the wide use spread. widespread use of cost plus pricing. Simply, these are the situations that why cost plus pricing is used mostly in the corporate world. And if you look at your book, if you read it carefully, then you will come to know that the explanation for widespread use and the advantages are same only. And as per our syllabus, we have to discuss advantages and disadvantages, so we will focus on that only. The first advantage is this method is simple and comprehensive, which does not need more information and price data for setting price to make marginal cost and marginal revenue equal. I have given you example how a price is set under cost plus pricing, and you also yourself will be clear that this is a quite easy and logical process. There is no need of much information, so this method is simple. It can be used by any industry. Here one thing is written that it does not need data to make marginal cost and marginal revenue equal. Now, in economics, there is a principle, and that we have learned in semester third in price output level as well, that price should be set at the level where marginal cost is equal to marginal revenue, because this is the situation where firm is able to sell the highest possible units in a market. But this process is very much complicated. You need much of information and much analysis is needed for that. So as compared to that method, as compared to that principle of economics, this cost plus pricing seems very easy and simple. Then second advantage is this method is more applicable to all the firms, whether it is a small or a big firm, whether it is a firm from cement industry or it is a firm from diamond industry, whether it is a firm from textile or it is a firm from FMCG. It applies to all. Though sometimes it becomes misleading to settle the total variable cost overhead charges to different products by the industrial unit, that we will see in disadvantage, but here you just remember that it is applicable to all the firms. Then the third advantage is the cost of product does not change in short period, so it somewhat becomes easy to settle the price. Under oligopoly market, little price changes may result in kinked demand curve. This method is useful to maintain rigid pricing. We have seen in the objectives of pricing that stability of price is one of the objective of firm, because if you maintain the stability in price, it will attract more customer, it will satisfy your customer, and it will increase your goodwill in a market. So if you want to have a stability and if your cost base doesn't change so variedly, then cost plus pricing is very useful. If your cost base does not change, so for example, if your per unit cost is 20 rupees for say 6 months or 1 year, then definitely you will charge the same price for 6 months and 1 year, and this will help in maintaining a stable price in a market. So the point becomes stable pricing or rigid pricing is decided by full cost pricing. Then the fourth advantage is cost plus price can establish a justification in change in price if the cost of production increases. See, the producer is not that much powerful that he can maintain a price for a longer period of time. Business environment is so dynamic, so changing, that even in a second the whole scenario could change. So if the prices of raw material changes, if the wage rate of labor changes, then producer is helpless in maintaining a price. But in that situation as well, when your price changes, customer will have question in their mind and they will straightly ask to you as well that why you are increasing price. And you can give justification that because the cost of production increases, I cannot afford to sell in now lesser price, so I have to increase the price. And this justification is ethical as well, and it will be accepted by customer as well. So this method helps you in satisfying the queries and the questions of your customer, and to make sure and to make them feel that you are not exploiting them, actually you are charging the ethical pricing only. Justification for change. Then next advantage is when a firm produces multiple products, this method becomes useful and easy. Say take an example of a firm which produces 25 products together. Now if they try to set the price on the basis of different methods, and one of the method is researching in market, analyzing competitor, and then deciding price, researching the demand scenario and the supply flow, and after that reaching to a price. This process becomes too much lengthy and costly. Now if you do this for 25 times for 25 products, then definitely it will take too much time and it would be a costlier affair. In as compared to that, if you follow the cost plus pricing, then the data of cost will be readily available within the organization. You need not to go out for the research. Plus you will add the profit margin, so it will not be time consuming and the process becomes much simpler for the organization. So it is useful for multiple products. The next advantage is, as we know that the production volume is determined on the basis of demand forecasting, demand factor is always uncertain. So the producers can take help of this method. See, how much to produce, that totally depends on the demand forecasting that we have discussed in the semester 3 unit number 2, demand forecasting. But demand forecasting is just a forecasting, it is just a prediction. It cannot give the precise result all the time, and sometimes the data related demand is not available, and demand to a great extent affect price as well. So if we depend only on the demand, then we will always be in dilemma that what should be the price. We will not be having a clear base when the data of demand is not available. In that situation, the cost plus pricing will come to our help. The next advantage is this method helps to decrease the cost of decision making. What is the cost of decision making? Simply means in pricing, sometimes we are hiring the analyst, statistician we are hiring who will research out in a market, who will analyze the competitor's price, who will analyze the market trend, and then he will give us price. Now the statisticians are not freely available, we need to give them fees who are highly charged. So it will increase the cost of decision making, but here the cost is determined by the top level management themselves only. We are not hiring any outsider, so we are not giving any extra salary or we are not incurring any extra cost just for setting a price. So here we can say that in cost plus pricing there is no decision making cost. Whatever is needed in cost plus pricing, that will be readily available in accounting department, and definitely your accountant will not charge just to give you a detail of your cost per product. It is his duty and for what he is paid for. So you are not incurring a single penny for deciding price under cost plus pricing method. Then this method becomes more helpful in following situation where price leadership exists. Production of commodity is for particular class of product, means we can say the product is not standardized but customized. Take an example of tailor product. Tailor is charging different price according to your specification. How much design you want to put up in your dress, accordingly he will charge. So for customized product, cost plus pricing is useful. Then public utility pricing. Public utility pricing, you can take an example of ST railway, which is provided by government for the betterment of public. Here government don't want to earn from the public, they are doing it for social welfare. But it doesn't mean government is allowed to incur loss, because if government will incur loss, they will recover from the tax payment from the public only. So whatever the organization, whatever the activities they provide to the public, if they don't earn profit, then also they have to cover the cost of their activities. And in cost plus pricing, there is a surety of covering up of your cost. The next situation is when the quality and the design of the product is as it was predetermined in advance. This point and the second is same, means where the customized products are there, this method is useful. So this is all about advantages of cost plus pricing. Now let us see the disadvantages of cost plus pricing. First one, instead of replacement and opportunity cost, this method is based on accounting and historical cost, which makes this method less trustworthy. So this method, cost plus pricing, is totally depend on a cost of production. Cost of production we derive from the books of account. So we can say that this method is accounting method. But you know very well that economics is more precise in case of business as compared to accounting. Accounting is having some limitations, and that limitations is overcome by the economics. And in most of the situation it is proved that the economic tools are much useful as compared to accounting tools. They are more precise and more meaningful as compared to accounting tools. And here, as this method is depending on accounting criteria, it fails to fulfill the criteria of economics. So to that extent, this method has limitation. Which criteria is not fulfilled? That it does not consider the replacement cost and the opportunity cost. Now what is replacement cost and opportunity cost? That we have discussed in semester 3 in cost analysis. But here you just remember that this method is based on accounting data. That is why it is having some limitations. The second disadvantage is here it gives more importance to average cost and somewhat ignores marginal cost of product and incremental cost. It assumes that the marginal cost remains constant, but after a long range, it becomes equal to average cost. As a result, it does lead to product price which are different from marginal revenue is equal to marginal cost. Here there is a printing mistake, marginal cost is equal to marginal revenue. In advantage also we have discussed that economics says that price should be set at a level where your marginal cost is equal to marginal revenue, because this is the level where firm is able to sell maximum units of a product, and it requires a long analysis, and that also we have done in semester 3. So here we just need to remember that it does not fulfill the criteria of marginal cost is equal to marginal revenue. Then next disadvantage is this method does not attain consumers' demand. It is important to study the relationship between the cost of production as well as what consumer pay for the product. Secondly, competitive elements exist in market. This method does not attain them also. See, if we see the factors affecting pricing, then lot many factors are there. Among them, the most powerful factors which is having a great influence on demand on price is first is demand and second is competition. If you ignore these two factors, you simply will be thrown out of market. You must be knowing the law of demand. Higher the price, lower the demand, lower the price, higher the demand. So price is having great influence on demand. If you ignore the demand, then whatever the price you charge as per your wish and will, it may not be acceptable to consumer and it may adversely hit to your demand. Secondly, we are ignoring competitive factors as well. How many competitors are there in a market? What prices are charged by them? We are not considering at all. Simply, we can say that cost plus pricing is a practice that a manager does within the four walls of that organization, where he is not looking into outer environment, where he is not looking into the market, and that is why it is having certain limitations, that it does not consider demand, it does not consider competition as well. Then the next disadvantage is if the cost of labor and raw material changes often, they will create problems. If every firm maintains the similar markup percentage to increase the prices, it will be a problem for each individual firm to sustain it. Either it has to attain the increased average variable cost or it has to reduce the markup level and thereby accepting for a down level of contribution margin means overhead and profit. See, what they say is that if your cost of labor and raw material frequently changes, then most of the time you have to decide, most of the time you have to spend behind deciding the price. Say for example, if your cost of raw material, cost of labor changes on a daily basis, then your most of the time spends behind calculating the cost and deciding a price. So in that situation, this method is not useful. Then the next disadvantage is there is an assumption in this method that cost can be divided into variable cost and fixed cost, but actually it becomes very hard. See, in cost plus pricing, we are calculating cost and we are segregating cost in accounting as variable cost and fixed cost. That also we have seen while discussing the BEP. I have given you a detailed discussion on the variable cost and fixed cost and semi-variable cost. After discussion, we came to conclusion that in reality, most of the costs are semi-variable costs, which becomes very much difficult to calculate. So when the calculation of cost itself is difficult, how can we say that cost plus pricing is easy? The difficulty in calculation of cost will be passed away to the difficulty in cost plus pricing. Then next disadvantage is all the firms do not decide their own markup level to determine price for their product. They have to be price maker or taker. The price leader will decide certain price and others will be followers to it. This price may be high or low depending upon the price of leader. See, in most of the industries, in the present market scenario, price is decided by market leader. Now, who can be termed as market leader? Who is a very efficient firm in a market. If the firm is very efficient, they are able to produce in a least possible cost. So, they can charge the least possible price after including their profit. But if the other firm tries to follow it, it may happen that the follower may not have that much efficiency as compared to leader. Say for example, if leader charges 10 rupees, now this 10 rupees covers the cost plus profit as well. But if this 10 rupees is charged by the other firm, it may happen that other firm may have the cost of production 11 rupees. So even the price set by leader is not able to cover your cost, and if you blindly follow the leader, then you will be having a very short life in a market. You are definitely going to liquidate your firm. So blindly following cost plus pricing set by leader is not a wise decision. We have to calculate on our own. If we are using cost plus pricing, then the cost should be of our organization only. This is all about the cost plus pricing. Now let us discuss the next method, that is going rate pricing. Going rate simply means, if we analyze the name of this method, then whatever the price rate is going on in a market that we are adopting, then this method is known as going rate pricing. Simply here we are not deciding price. Whatever the price is decided by market, we are taking it. So here we are price taker, not a price maker. Now let us discuss in detail. Instead of the cost, the emphasis here is on the market. The firm adjusts its own price policy to the general pricing structure in the industry. Where costs are particularly difficult to measure, this may seem to be the logical first step in a regional pricing policy. See, first method we have seen the cost plus pricing policy, where we are calculating cost. After that we are adding profit margin and we are deciding price. But in all the situation, calculation of cost is not an easier task. In that situation, adopting the going rate pricing will be a wise decision. It may also reflect the collective wisdom of the industry. Why collective wisdom? Because the price set by market is adopted by every firm. Every firm is accepting it, means every firm is wisely accepting this price and becomes the trend of the industry. Where price leadership is well established, charging accordingly according to what competitors are charging may be one safe policy. It may simply be a way in which a firm tries to escape the hazards of price rivalry in an oligopolistic market. It may be less costly and troublesome to the business than the exact calculation of cost and demand, and superficially seems to have practical advantage over a highly individualistic pricing policy. See what this says, that why we are adopting the price decided by market? Because we want to avoid the price rivalry. We want to avoid the price competition. Now what is price competition? That we have discussed in unit number 1 very well, where we are charging less price to attract more consumer, but then we have to be ready to face the counter moves of our competitors, and ultimately no any business player will be at benefit. So just to avoid price competition, we are accepting the price decided by leader and decided by a market. The another advantage we can take is, if we are accepting the price which is decided by market, then we are going with the flow which is accepted by majority of the public, and it is having definitely more benefit than the individualistic approach. Your individual price may be different, and it may happen that customer may not accept it because the major trend in a market is quite different as compared to your individualistic approach. So in that case also, this going rate pricing is beneficial. Now that's all about the introduction of going rate pricing. Then one of the example of big corporation of America is given. You can read on your own. Let us discuss the advantage of going rate pricing. The first advantage is sometimes it becomes difficult to get data and information about cost or demand schedule, or if this process proved expensive, it depends upon the know-how of the producer to decide the pricing, keeping in mind the return on investment. So basically three factors are there which has a great influence over price. First is competition, second is demand, and the third is cost. Now, if we take the example of cost, in introduction also we have taken this example that in some of the situation, the calculation of cost becomes too much difficult and time consuming. It is better to accept whatever the price is set by market. Again, if we are a new firm in a market, we don't know what is a market trend, then researching the demand scenario in market would be difficult for us. So we don't have data related to cost, we don't have data related to demand. In this situation, it will be very much time saving and easy to accept the price which is decided by market. Then second advantage is in the competitive market, uncertainty is found both in demand and in selling. This method minimizes the uncertainty by applying competitive prices or changes in pricing. So if we decide a price which is based on demand, then demand is a factor which is quite volatile. It may have a great high and a great low depending on the season, depending on the market scenario, depending on the technology and lot many other factors. So when demand changes, your price will change, and this may create uncertainty, instability in pricing. So if you want stability, then also adopt the market price will be an wise task. Then third advantage is this concept is useful to small firms as well as large firms. The large firm is price maker. It is not price taker. Make correction. It is a price maker. So it has to follow only the price leader or by the market. This going rate pricing is useful for every firm, be it a small scale firm or be it a large scale firm. It does not create any distinction between the large firm and a small firms. Then next advantage is when the competitors prepare to accept common pricing, this method becomes helpful to establish stable pricing. It is mostly found in oligopoly market. See, oligopoly market, you know very well where the price rigidity is existing, where the price is decided by group behavior, and once the price is decided, you are not allowed to deviate from the price. Means whatever the price is set once, you all have to follow it. Means the price is set in a market, whether a new firm or an old firm, they have to follow it. So for oligopolistic market, this is a usual or a routine practice to have a going rate pricing. Then this method is useful to companies which are at maturity stage. This is because the customers and rivals want stable pricing. You know the product life cycle, 5 stages are there: introduction, growth, maturity and saturation. And maturity is a period where the market is quite stable, quite aware about the product, and now they want stability. In introduction, the product is new. After growth, the companies want more profit, that is why price is changing. But now maturity is a phase where the consumer who want to purchase it have already purchased it, and now their demand is only for replacement. This is a stage where you cannot change the price, where the customers and even the competitors want stability, because it is a stage where the firm is not focusing much on this product. They are focusing on launching a new product, because this product which is already having maturity phase will soon or later be entered in decline stage and will be the history in market. And why to focus much on this product? Why to attempt much for this product? It is better to give attempt or efforts for the other product which is having future. So just to lessen the effort of management, they are trying to follow going rate pricing. Now let us discuss the limitation of this method. The first limitation is we have assumed that the firm take decision about pricing according to their know-how and understanding, but in fact all decisions do not lead them to maximum profit. As we are here adopting a price decided by market which does not guarantees that you will earn profit in a same price. Maybe you are inefficient, your cost is more than the price. In that situation, you are incurring losses. Then second disadvantage, we have seen that this method is based on price taking from the other competitors. It will establish stagnancy in selling the product. Secondly, it will encourage new firms to enter in the industry and to create more competitors. Firstly, if you are doing business, then you are doing business because you want to be boss of yourself. You don't want to follow anyone, you don't want to take instruction of anyone. And here in going rate pricing, we are straightly taking the price which is decided by someone else. Here no logic of yours is used, no mind of yours is used. So to an extent, the ego of producer may hurt in this method. And secondly, in going rate pricing, the price is stable for a longer period of time, and because of that reason, industry is having stability. And stability is a period where there is a ease of doing business. And any industry where there is a ease of doing business, it will attract more players. So by attracting to the industry, more players will enter the market and it will increase competition. So going rate pricing may be disadvantageous from this point of view. Then next limitation is to accept price taking is not advisable. If any firm tries to set up its own pricing, it has to come in conflict of other firms. It will create uneasiness in the industry. Anyhow, the firm has to find out middle way to avoid such conflicts. See, if you accept the price, then your ego is hurt, and if you decide your price, then either you will lose the customer or you have to face a strong rivalry from the market, from your competitors, which will take much of your time and efforts in facing a competition, not focusing on business. So it is better to follow the going rate pricing than to decide your own price. This is all about going rate pricing and cost plus pricing. We are keeping our lecture up to here only. From next lecture, we will discuss rest of the methods of pricing. Till the time, have a great day. Thank you.